From the financial centers of the world, this is Bloomberg Markets with Alix Steel and Guy Johnson.
It is 30 minutes into the U.S. trading day on this Tuesday, December 21st. Here are the top market stories that we're following for you at this hour. Free tests, no lockdowns. President Biden addressing the nation today on his COVID response plan, promising 500 million free tests. We speak to Stan Erck, Novavax CEO, about where his vaccine fits into the picture. And it's Comeback Tuesday yet again. Equities, commodities stage a rally after getting beaten up on Monday. What would signal an unviable dip? And Turkey's de facto rate hike. President Erdogan promises to pay more lira to deposit holders, trying to put a floor under the currency's free fall. Is it going to work? From New York, I'm Alix Steel with my co-host in London, Guy Johnson. Welcome to Bloomberg Markets. Guy, I feel like if we can't take yesterday's price action seriously, do we really have to take today's price action seriously? When do we get a clean read on the market?
I would say today's price action is less useful than yesterday's price action. The volume is down. I don't think you're getting a particularly high level of participation in the market today. Yes, we're up, but it doesn't feel that convincing. Yesterday I thought was pretty interesting in as much as what we saw there was actually the selling reaching into lots of different places in the market. And I thought that was fascinating, because that wasn't just a kind of, we're going to sell big tech. It was like, we're going to sell pretty much everything.
Yeah.
And I think that may be an interesting little narrative that's worth paying attention to.
Yeah, the rotation in the market, too. And it's hard to know if there's a story we can really take out of it. Like Pfizer down almost 6%. That's the biggest intraday drop we've seen since June of 2020. On the flip side, Nike and Micron, after having a better outlook for 2022, kind of outperforming. How do those two fit together? I don't know. Maybe we're in a stock picker's market. We have to wait for a narrative to really take hold.
Well, I think we just need some clear signals. I think we need to get through the holidays. I think we need to get people back. Maybe people don't come back. Maybe Omicron is a feature of the landscape early on in the new year. I think there's a lot of things that are hard to judge at the moment. And I think the market's slightly struggling with it. But I think the one clear takeaway, and Gina Martin Adams was really pointing this out a little bit earlier on, was take a look at the NASDAQ 100-day moving average. Market gets pinged down to that, bounces off, and that is just repeating time and time again. And Alex, that takes us on to our question of the day. When do we get to what signals an unbuyable dip? At the moment, the market is conditioned, absolutely conditioned, to continue to buy the dip. Well, let's kick this around with our guests. Catherine Rooney-Vera, Baltic Capital Markets Chief Investment Strategist, and Bloomberg's Vince Signorella. Vincent, to his friends and mother. Okay. Nice to see you, sir. Vince, what did you make of the price action? What do you make of the price action over the last couple of days? We're back. We're buying the dip. Today doesn't feel that convincing to me. But as I say, we're bouncing off that 100-day moving average. The trend largely feels intact.
It does in some way, and actually we're bouncing off the 100-day in the S&P, where we haven't really challenged it. It's been the same kind of pillow that sort of captured and held the market pretty much into 2021. You also made a good point about volume. A lot of traders at this time of the year are settling back, more trimming positions than really aggressively trading. You've seen a bit more day trading, perhaps, but longer-term positions are taken off a little bit at this time of the year. No one gets paid a bonus on what they make in December, and you can only get bonuses taken away. You can't get them added on. So a lot of folks are stepping back, watching this game, and I don't think you're going to get a real read on the trend for the market until we get our teeth into 2022. And
you make a good point, Vincent. You know, I'm looking at some of the market action here. Cassava Sciences was up 50%. That was on Reddit. And now it's just about up 31%. But that meme stock and the day traders, like, clearly in the market in some capacity. Catherine, it's great to see you. Same question for you. What signals an unbuyable dip?
Well, of course, a dip by definition is something that's going to bounce back. So if we know it's a dip ahead of time, everyone's going to be buying it. But a major correction, I think, would have to be precipitated, Alex, by the market realizing or knowing for sure that the Fed is not going to be there to support it. So a loss of credibility by the Federal Reserve, or a change in, not just a change in tune, Alex, but a complete 180-degree shift in how the Fed engages in monetary policy, I think would be what would startle the markets and cause a major downside reaction. That is, of course, that the Fed is, not just suddenly cuts tapering altogether and hike rates, or does something to that vein. I think it would cause the market to really lose faith in this structural upside move that we've seen for the past, decade.
Yeah, it's been about a decade. Catherine, have you been surprised how well investors, particularly equity investors, have taken in their stride what the Fed has done? We've had an accelerated taper. The market shrugged its shoulders. Yeah, we're still good to go. We've got 3 rate hikes priced in for next year. Yeah, you know what? We're good to go. What Fed policy would actually change the narrative that the market is comfortable with? What would it take to get us over that hump? Maybe the balance sheet roll-off, is that a factor we should think about? How should we think about the Fed and the way that the market is reacting to it?
The market just sees that the Fed is infallible, right? It's just stunning that you can see this amount of curve flattening and this amount of little reaction by the Treasury market to a Fed that's really changed its tune, Guy, right? I mean, instead of 2, we have 3 hikes. We have a doubling of the taper. We have certainly more hawkish bent. The central bank saying that inflation is enemy number 1 to the economic recovery. So, and the market really is unscathed. That tells me that the market is already discounting both an economic deceleration, which is inevitable because this year we will have grown above 5.5% for the U.S. economy, but also that the Fed is able to tackle inflation so that, yes, there is inflation. We know it, we realize it, but the Fed has got it. So what could really deconstruct that, pillar of the market mentality would have to be that the Fed is hiking rates, but inflation still doesn't come down. And that we're not going to have until the second half of next year. So, Guy, my view and what I'm telling our clients is risk is still on, stay long, overweight equities, continue to buy any scare on a new variant. It's clearly a buying opportunity. We've seen it with Delta. We've lived it with Omicron. So continue risk on positions. But hedge those, buy those sectors. And we've said this at Baltic for the past year. Inflation is the real risk. Buy inflation and rate sensitive sectors and asset classes that can protect that other portion of your more risky portfolio.
Yep. In the meantime, buy the dip, ... until something changes in that respect. Hey, Vincent, where does that leave the dollar? I was really interested in the price action yesterday that I didn't feel like the dollar was responding in the same safe haven kind of bid that we normally see when we have a risk-off day in the equity market.
Well, I think it wasn't so much a risk-off day as it appeared. People seem to be wanting to say it was a reaction to the Build Back Better plan. I think it was more of a reaction to the variance spread. I think going forward into next year, we still see 2 sides. I think Catherine hit the nail on the head with the Fed. As long as the market feels that the Fed still has their back, not that they're going to raise rates, but that they have a handle on inflation, which still remains to be seen, and they could still lose that one. The dollar is going to appreciate. Basically, my view is dollar goes up. Either the variance spreads and people rush to it as a haven, or the Fed overreacts and raises more aggressively. And of course, that gives people a reason to buy the dollar as well.
Vince, we've had a really strong run. What does history tell us about what next year could bring? What does history tell us about the chances of repeating another year like this year?
That is a really good question. History tells us there's always an opportunity for a pullback, and then you get that by the dip scenario. There's a very, very good chance we could see a 20% correction next year. There are 2 things going on in the market that I personally am not crazy about. We're starting to see a dip in personal spending and, more importantly, personal income. That is eroding real personal spending power for the consumer. If that continues with inflation going up and we don't see an increase in wages, it's okay to get inflation, but we need to see a commensurate increase in wages. If we do not, the buying power of the consumer is lower, the opportunity to spend is lower, earnings are lower, and therefore stock prices have to come down. And that is what we're starting to see right now. So unless we see a push from the consumer to have wage control, to get an increase in wages, we may very well see somewhere 3 to 6 months from now a major correction in equities.
Womp womp, 20% correction, 3 to 6 months. That is a serious projection. Catherine, you outlined what we need to see a serious correction. Let's play the what if game. What goes on sale if we see something that dramatic?
What goes on sale? Yeah, I mean, if we get a 20% correction, and it depends on, of course, what the motor of that correction is. But as Vincent said, I think it's a good point. Real wages are what you need to be looking at, especially if we're talking about inflation and how, persistent, or as the Fed, I think jokingly must have been joking when they said persistently temporary. But really the question, I think, is with the wage price spiral. So as he said, and that's right, if you get real wages that are continually and persistently increasing, as we have seen, real wages are up and they're up big. If that's not counterweighted by by productivity gains, which Jay Powell has consistently said has been the case, but if that ends up fading, or we get a drop in productivity, then we get some serious inflation pressures from the wage perspective, the wage price spiral, which I think is, of course, very pernicious. So we have demand pull inflation, we have bottlenecks. If Omicron ends up exacerbating the issues that we've seen with the global supply chain, then inflation becomes even a bigger issue. So my biggest concern here remains the risk of policy error. Either the Fed has to jack up rates, either in a bigger magnitude and quicker, or they take a more dovish stance and let this unfold because they're concerned about unemployment, they're concerned about economic growth. The Fed is going to be hiking in an environment of decelerating economic growth. Right. That's not a comfortable place to be hiking rates. So there's definitely risk, and I agree with your other guests with regard to risks going into the future. I do think, though, that the Fed is going to give inflation a pass for the next 6 months. So I'm more on the bullish camp for the next 6 months. I think risk stays on. I think the Fed is still backing the market. We've heard 2Q, 3Q. Jay Powell says he expects inflation to decelerate. Yeah. If we don't get that, then I do suspect we're going to be seeing more aggressive moves from the monetary policy front.
All right, and we're going to break down kind of what all this means for other asset classes elsewhere as well. Guys, thanks a lot. Vincent Signorella, always good to see you. Catherine Munivari of Bolte Capital will be sticking with us. We're going to break down how to position for a Fed rate hike path, how to position for a policy mistake, what it means for the dollar, then what it means for emerging markets as well. This is Bloomberg.
I've been pretty optimistic from the lows, simply because the Fed was going to be ultra accommodative. And as the central banks begin to move off that accommodative pivot, it means that equity returns are still going to be positive, but they're going to be lower. And in that environment, I simply think that it requires a little bit more of a balance between risk on stocks and risk off stocks.
Andrew Sliman, Morgan Stanley, talking a little bit earlier on, talking about how the Fed is going to affect the equity market outlook from here. Catherine Rooney-Vera, Bolte Capital Markets Chief Investment Strategist, still with us. Catherine, Morgan Stanley are quite cautious in terms of their positioning on the street right now, but they make some interesting points about what is going to happen next. We've all got very conditioned to this idea that we're delivering and we're able to manage kind of outsized returns. It's been a fantastic year this year. Maybe we go into a more kind of low single digit, maybe even high single digit return story, but nevertheless, it is going to be single digit. In that kind of environment, do I want to position for the dips, to carry on the conversation last time? Do I need to keep capital back to take advantage of those opportunities, or do I just want to be fully invested throughout this entire process?
Yeah, Guy, I think it's a fantastic idea to have some dry powder on the sidelines for any potential dips. There's a lot of questions still in the air, not only from the COVID perspective, but also from the monetary and fiscal policy perspectives, as well as with economic growth. Is it going to be a steeper slowdown than a lot of people expect? And Morgan Stanley, I just heard from him, but we've also heard from Goldman Sachs, and they've reduced their economic outlooks for 2022 for the U.S. economy a couple times, if I'm not mistaken, in the past week already. So yeah, I think it's a fantastic idea, but I do agree we have to be defensive. So we're going to be buying sectors or even geographical regions that have dragged the U.S. performance a little bit. So healthcare in the U.S. we like, the valuations are still attractive. Banks we like because we do expect some sort of steepening of the curve in our base case scenario for next year. Rate hikes, banks, of course, are a beneficiary of that. Europe and Japan still have dragged the U.S. performance, so we see additional upside there. Within the emerging market space, there are some selective opportunities as well. So, the markets always present opportunities. We still see some right now. While we are seeing additional upside in equities over the course of the next 6 to 10 months, we are actively advising clients to engage in those, have some cash, have a position in cash, but certainly hold a position in gold, have a position in alternatives, names that have lower correlations with the equity markets.
Hey, Catherine, does all of that imply a weaker dollar relatively?
Yeah, look, the dollar has countervailing winds. So on one hand, we do expect the Fed to hike rates where their counterparts in Europe are not going to be doing so. But at the same time, we have fiscal deficits that are still, 10% of GDP, and we have a lot of downside to the dollar. I personally think, Alex, structurally, the dollar is weaker and going weaker. But over the course of the next year, as I said, there are some countervailing winds to that theory. And the first of which is a difference between what the Fed is doing and what other developed central banks are doing.
In terms of the emerging market call, where specifically are you looking? It's very easy to talk about kind of emerging markets as if they're all in one bucket, but they're not. Right. How do I separate and segment?
Yeah, sure. So Latin America does present some interesting opportunities. We had a shock election, if your audience has been aware of this, in Chile and in Peru. There have been some really surprises. So next year is going to be a tumultuous year there because we have some additional elections that could jolt the markets. But I do think there are some opportunities. For example, in Brazil or Mexico, both in fixed income and in the equity spaces, there's quasi-sovereigns that are energy-based names that we find attractive in the fixed income space because they have a nice, juicy yield. And also in the equity space, the Brazilian real remains very oversold. Then within China, we like Chinese consumer discretionary. This is a structural recommendation, and China has been beaten up, as we probably all are aware, over the past couple of months. So we do see some opportunities there. So yes, it's not all EM are not created equal, but we do see opportunities, especially in China, in Brazil, and in some cases in Mexico.
So, Catherine, let's stay on China for just a moment. What kind of policy support do you think we're going to get on the monetary and fiscal front from China that would support your view? Because in theory, they have to do that in order to help people buy stuff.
Well, I can tell you what doesn't support my view. My biggest fear here is that the Chinese authorities decide to devalue the yuan. I think that's a possibility, because if the Chinese, in theory, are accepting a slower economic growth, say 5.5%, are they really willing to cede almost wholly their market share as the yuan appreciates in terms of exports I'm talking about? So this is probably, for me, one of the biggest risks, is the potential for a devalue of the yuan to support export markets. But that goes in against what the authorities have been trying to do, which is make China a superpower both economically and politically. And in that vein, they need to support the domestic demand component. So to be supportive of my view, I think that the authorities would have to continue their structural objective of getting China from an export powerhouse and roads to nowhere and ghost town infrastructure-based economy impulsed by government spending towards one based on private investment and private consumption. And I think that's the direction that this economy is going. And that's why we have been recommending at Bull take this structural long position in this area.
Do I buy direct or do I buy the proxies? Do I buy Nike on the fact that it may start to... Nike. I'm sorry. Nike. Got us a victory.
We'll forgive you.
Nike's struggling in China right now. As that starts to turn around, do we start to see some of those consumer stocks that have been focused on China in the past starting to come back and come back strongly? Do I need to go direct to China, or can I buy US multinationals, European multinationals that take advantage of that?
I would buy actively managed funds that focused in China. There are some excellent ones out there, and we're not going to pretend to be experts in all of the subsectors and specific names within China. So what we're recommending to our institutional and retail clients is precisely that: actively managed funds by guys who are focused exclusively on China. That's where we think value is, and that's where we put more faith in the ability for active managers to do that. So that's probably one of our most important emerging market recommendations entering into next year. Of course, there are risks. There's the devaluation, there's additional variants, there's additional closures, there's the potential for really black swans to happen. But the way I see it right now, with the Fed hiking, with global economic recovery, and really vaccines at least improving the fatality rates of COVID victims, I think there are opportunities in those undervalued areas, such as China, such as some emerging markets names, such as Europe and Japan, to outperform.
All right, Catherine, thanks so much. Really appreciate it. Catherine Rivera of Bulltech Capital joins us. Coming up, we'll talk about Nike. I was like, what company is Nike? Nike does it. Shares are up today on a sales beat. It also said consumers won't have to worry about those Air Jordans making it under the tree. More on that next. This is Bloomberg.
Shares of Nike are jumping after the companies. Yeah, I'm just here to help. The latest results. Bloomberg's Kriti Gupta digging into the details.
Absolutely, Guy. Nike actually beating their earnings estimates. And it's not the first time they've been beating them since that 2020 pandemic essentially halted the global COVID spending, and Nike was no exception. But take a look at this, a little bit of a divergence when it comes to who's driving those sales. Compare this North America sales to Greater China sales. One is negative by almost equal to the amount that North America is. So you can really see in Nike's earnings, the United States in particular was driving those sales higher, helping them offset the costs and offset the loss of sales that you're seeing on the other side of the world. A lot of that driven by, of course, those production delays in Vietnam, as well as just kind of reduced spending ability over in China. You see that in broader retail sales data as well when it comes to the kind of zero COVID testing policy that has really created some pretty tight restrictions over there. But take a look at this. Nike is no exception to the margin pressures that have been such a major part of the 2021 story. Take a look at this. This is, of course, the fiscal quarter. They go by a different calendar than we do, but you do start to see margins actually down from 15% to 12% in this latest quarter. And that's going to be a major issue going into 2022 as we talk about those supply chain issues.
Yep. Love Nike. Kriti, thanks very much. Kriti Gupta joining us there. If I have to say aluminum, he's going to say Nike. All right, coming up, New York City Mayor Bill de Blasio talking about $100 to get your booster. We'll talk more about the virus. This is Bloomberg.
One hour into the trading day on Wall Street. What do you need to know? Abigail Doolittle has the details.
Well, Guy, we are seeing a little bit of a rebound here for U.S. stocks after the three-day sell-off, but little is probably the key word. At this point, we're looking at a gain of 0.5% for the S&P 500. That NASDAQ up 0.3%, but we're seeing bigger gains for the small-cap Russell 2000, which, of course, is well below its 200-day moving average, so you could make the case that there's a catch-up trade there. Plus, the bank index, that KBW bank index, up more than 2%. That, of course, has everything to do with the backup in yields, because over the last 2 days, we do have the key benchmark 10-year yield up about 8 basis points. And interestingly, because, of course, after the Fed went more hawkish last week, we had yields drop. But if we take a look at a roughly 5-day chart of the 10-year yield, we are going to see this was the Fed meeting. So basically at the same levels, 148 down and now back up. So a round trip. The 1-year yield trend, as I've been talking about recently, it is up and away, suggesting that we may, in fact, see yields go higher from here. As for the S&P 500 and that rebound rally, will it last? Well, it's hard to say, but we can see here that earlier this year in September, we saw some chop around the 100-day and 50-day moving average, suggesting that investors were very uncertain, didn't really know. Right now, we have a very nice test off of that 100-day moving average, trying for the 50-day moving average above it just slightly. Let's see whether or not we go toward the highs there. There is some reason, Guy, to think that that could be the case, that we could see investors go back toward the highs of the range. But the bigger question is not the range itself. What way will it break? Hard to know, but that will probably be a 2022 event, Guy.
Absolutely. Do you buy the first one, sell the second one in terms of tests? We'll wait, we'll find out. Abigail, thank you very much indeed. Let's talk about what's going to happen a little bit later on today. President Biden's economic agenda might not be dead in the water after all. Bloomberg has learnt that there might be a path open for more talks with the West Virginia Senator Joe Manchin. Anne-Marie Hordern joining us now, Bloomberg's Washington correspondent. She's got the latest, and she's here to give us an idea as well what the president might talk about at 2:30. But let's deal with Manchin first of all. So they had a phone call. Do we know how it went? Do we know what came out of it? Do we know where the areas of progress could be?
Well, the fact that the White House does think that there is this opportunity to move forward and the door is not completely shut, it does seem like the phone call did go pretty well between the president and the senator. And also this evening, we should note, Senate Democrats are going to be speaking all together around 8 p.m. A telltale sign, I think, of how discussions will be moving forward is whether or not Senator Manchin actually attends that meeting this evening. But, Guy, when it comes to the policy point, Senator Manchin really is keen on making sure they tackle the revenue portion, so taxes, and also paying for universal pre-K for 10 years. One issue that is really going to be a sticking point is those child tax credits, something the progressives want, something the president really wants, and they run out at the end of this year. That is something that Senator Joe Manchin really wanted to have more measures surrounding if they were going to go forward with that. But these are going to be a lot of questions the president will face if he takes questions, Guy, later this afternoon. And that's when he's going to be giving his speech about COVID. And that's going to be focused on hospitalizations, making sure they can tap the Pentagon if there's need for service members to help with hospitals in January, February. Also testing. They are going to be having more pop-up testing locations. The first is going to be in New York City, where you see just lines wrap around some of these city streets. And then, of course, also they'll be sending home about 500 million testing kits for Americans that want them for free, something that Europe has been doing for quite some time.
Yeah, I know. It feels like that's great. Too little, too late, or is that going to be enough? Anne-Marie, thanks a lot. Bloomberg's Anne-Marie Hordern joining us there. We're going to bring you live to the President Biden's speech later today at 2:30 p.m. in New York, 7:30 in London. Well, let's stick with the virus and U.S. policy response. We're joined now by Catherine Baker, the University of Chicago Harris School of Public Policy Dean. Thank you for joining us. So the idea that we're going to have more pop-up tents, 500 million tests sent in January, is this going to be enough to stop this surge and protect hospitals and healthcare workers?
Well, at this point, I'm not sure anything can stop the surge, but having readily available free testing is key to making sure that we can keep rates as low as possible while maintaining economic activity. And no one wants to go back to a world of lockdown and unemployment. Having a wide array of tools available to keep us healthy while we're socializing or working or being out in public seems vital.
Catherine, is testing a smarter way to change behavior than, say, mandates? We're trying to force people, we're trying to pay people to get vaccines. However, some people are resistant to that. Handing out free tests, I wonder whether that is a way actually of getting more people to alter their behavior, to recognize the risk, rather than forcing them down one particular avenue.
I think we want to incentivize lots of behaviors at the same time. Having free and readily available testing is going to be a huge help, but I think we also want to continue to incentivize vaccination. Vaccination is much better than prevention of transmission alone through masking, hand washing, testing. All of those are important, but they're complements to vaccination. So I'd love to see strong incentives, and they can be positive incentives on all of those behaviors.
We're expecting to hear from President Biden that there's going to be no lockdown restrictions. Is that the right way to go? Do we need targeted restrictions, particularly when it comes to schools? What do you think is the best policy?
If we could properly incentivize people to get vaccinated, get boosted, test regularly, and that's, PCR testing when it's suggested by having a real exposure or having symptoms, but home testing before going to even small gatherings. I think if we could incentivize all of those, we wouldn't need to have lockdowns. It's really important that people use those layers of protection, and the negative incentives may not be as effective as the positive incentives, by which I mean making things free or even paying people to do those things. There's been evidence that the negative incentives in terms of mandates have had some limited effectiveness on people's behavior.
Catherine, when you look at what is happening on the ground right now, what are you learning? Is what we are seeing with Omicron, which is becoming by far and away the dominant force here across Europe and increasingly in the United States, is this playing out in the same way that the previous waves have? Are there critical differences that we need to adapt? I'm just wondering if the kind of the playbook from Delta is the same playbook we should be applying to Omicron.
Well, one of the things we're hearing from epidemiologists and medical experts is that the latency period, the period where you're exposed but not yet infectious, may be shorter for Omicron. And so that means it's all the more important to have really readily available testing, because you may not have as long a window to catch people before they start infecting their neighbors, their colleagues, their classmates. So I think that will change the playbook a little and up the importance of that toolkit we've been talking about.
So we're not going to get these free tests until January. What would have to happen for us to be able to just walk into a CVS or Duane Reade and get a free test? Like, would that ever be our reality? That's what Guy gets to do over in London. Is that going to be something that we can actually implement here?
There are a couple of things that need to fall into place for that to work. First of all, we need the supply of the tests, and I understand that that is gearing up as quickly as possible, but that we're still short, and the supply chain problems that we've seen throughout the economy are present there too. But then there's also the free part. We need to make sure that the funds are in place, whether it's through private insurers, whether it's through the government mailing tests, so that people don't face any financial barriers to getting those tests. Similarly, we need to make sure that tests and vaccines are available to people in ways that work around their work schedules, their school schedules. We can't expect people to take a lot of time off work to be able to follow those best practices. So we need supply, we need the money in place to do it, and we need the convenience to make sure that it's readily available in people's real lives.
In an ideal world, let's say that there was no shortages, that there were tests available. I'm talking about the lateral flow tests here. How often with Omicron do you think I would need to test? As you just said, the gap between getting it and becoming infectious is incredibly short right now. And I've certainly seen examples of that just anecdotally in my own life, that people get it very quickly. They test negative one day, they're testing positive the next day, and you can see the impacts of the spread of that person getting it to other individuals. How often with Omicron do you think we need to be testing? Is it every day? Is it every week? What do you think the duration should be?
Well, I'm not a medical doctor or an epidemiologist. I'm an economist, but I understand the importance of incentives and of externalities, the way any person's behavior affects other people around them. So thinking about the times when you are at risk of transmitting the disease, that's going to vary person to person based on whether you can work at home or need to work outside the home, whether you're in conjugate settings or more on your own. Whenever you are at risk of spreading the disease to other people, that seems like a really good moment to test, and making sure that there are both the economic incentives and the social and behavioral norms. We know that people respond both to monetary incentives and to behavioral nudges, and we want to get both in place.
Yeah, it's the modeling. I'm just curious as to how it affects the models and how quickly transmission works off that. And as you say, how people are incentivized to make it work. I think it's a fascinating story, because at the moment, I think even rapid testing is causing gaps, pretty big gaps, to appear in the system. Catherine, really appreciate your time. Thank you very much indeed. Catherine Baker, University of Chicago, Harris School of Public Policy Dean. Greatly appreciated. Next hour, we're going to speak to Stan Erck, Novavax's CEO. He's just had his vaccine approved in the EU. We'll get Stan's take on what is happening here. We're also getting news from the FDA within the last couple of minutes. Alex, the FDA now expected to authorize the Pfizer and Merck COVID pills. That is expected now to happen this week. So further tools in the toolbox for dealing with this Omicron wave.
Yep, that would be the first at-home treatment for COVID-19. Those stocks off the lows of the session. All right, coming up, Nike is saying that the worst of its supply chain issues may be over. What about other retailers? Are they seeing the same thing? We're going to talk to CEO of global outdoor brand Tim Boyle of Columbia Sportswear coming up next. This is Bloomberg. This is Bloomberg Markets. You are looking at a live shot of the principal room. Coming up, Roger Rollins, Designer Brands CEO at 2:30 p.m. New York time, 7:30 p.m. London time. This is Bloomberg. Let's check in now on the Bloomberg First Word News. I'm Alix Steel. Another study is now reinforcing the need for coronavirus vaccine booster shots. According to researchers, 2 shots of the AstraZeneca vaccine protects against severe illness for only about 3 months after the second dose. The UK relied upon the Astra vaccine for primary inoculation of people over 40. And the Turkish lira swung wildly after gaining about 50% this week. Investors deciding whether government measures to shore up the currency are sustainable in the long run. The lira fell by as much as 7% against the dollar at one point after soaring 20%. I mean, that's some whippy action. And that is your First Word News, Guy.
Okay, let's talk about, let's carry on the conversation about what is happening with COVID-19. When COVID-19 emerged nearly 2 years ago, the impact on the economy was massive. It upended retailers around the world, but it brought long overdue changes. E-commerce was a major beneficiary. Bloomberg's Romain Bostic takes a look.
The pandemic shock to the global economy disrupted every sector of business, but it was the severe blow to retailers that is now proving to have the most transformational industry effect.
Retail is like the 9/11. It's a hurricane.
In early 2020, physical stores closed their doors. Customers and workers alike locked down at home. What was supposed to be a temporary sacrifice turned into more than a year-long struggle to remain viable. That struggle was insurmountable for some retail chains, and many of the mom and pop stores just seemingly disappeared overnight. But the pandemic also spurred overdue change that is increasingly being seen as a net positive for global retail, which has already seen a startling turn from where it was in mid-2020.
We have consumers who basically have the dollars to spend. Retailers are giving them innovative products.
The pandemic created the incentive that many needed to fully commit to e-commerce rather than just dabbling around the edges.
We'll walk side by side with our guests with a business that's flexible to how they want to shop, whether that's a box on their doorstep or increasingly a drive-up trip to one of our parking lots or the classic in-store trip.
In China, stores started selling goods via live video streams. In Mexico and Russia, companies built more secure payment systems to make consumers comfortable shopping online. In Brazil, retailers turned to instant messaging platforms like WhatsApp to offer promotions and finalize transactions. And here in the US, chains added features like video calls to ease the reticence to making those big purchases online. And while the online pivot allowed companies to regrow in an unprecedented time, brick and mortar is far from dead. Physical store shelves are still where the overwhelming majority of goods are bought. In the US, chains with more than 50 stores, they're expected to add more than 4,000 locations this year. And that'll mark the first increase since 2017. Many of the country's biggest chains are drawing a lot more shoppers than before the pandemic. Target, Lowe's, Foot Locker, Ulta Beauty, and Bath & Body Works. The comeback is a big reason why the Spider S&P Retail ETF has surged this year, beating the S&P 500's advance. The innovation and intertwining of brick and mortar and the internet, spurred by COVID, have allowed retailers to recover and come out stronger than ever. Now the question becomes, will the changes stay resilient in the face of Omicron?
That was Bloomberg's Romain Bostic joining us. And you can hear more about how COVID changed retail in our Big Take special today at 2 p.m. in New York time, 7 p.m. In London. And for more on retail, we're joined now by Tim Boyle, Columbia Sportswear Chairman, President, and CEO. Tim, it's always good to chat with you. We just sort of had a journey as to how retail evolved over the last 2 years. What's your visibility for 2022?
Well, I think we thank our lucky stars every day that we're not in the tailored clothing business, making, present company excluded neckties and sport coats and tuxedos, because people have adopted a lifestyle that's reflective of what they wear, and it's really, in many ways, an outdoor lifestyle. So it's been great for our business, and I think the expectations for 22 and beyond are going to be the same, or more outdoor activities for families and people who are interested in staying healthy and safe.
Tim, the real surprise to me was not actually on the front end. I think it was logical that a lot of retailers went to e-commerce. We just accelerated a trend that we've already been on. I think the real surprise that came out of the pandemic for a lot of people when it came to the retail sector was the supply chain story. It wasn't the demand side, it was the supply side. In terms of how much progress has been made there, what is your perspective? We've clearly seen bottlenecks continuing. Are they abating? What lessons have you learned in terms of managing supply chains over the last two years? What can you take forward from here?
Well, our company, like many others, had a very heavy reliance on Vietnam, primarily because Vietnam had a terrific labor force, very high quality labor operators, and the government of Vietnam had done a terrific job of negotiating with various vendor countries, including the U.S., Russia, Canada, et cetera, on favorable duty rates. So it was a naturally good place to go get merchandise made that's high quality. I think what we've learned is, that you should have some sort of variation in your sourcing base, which we have, and that's been a learning for us. I would say that the constraints around the logistics area that we've all talked about ad nauseum have been much more pronounced in the U.S. than they have been in other parts of the world.
Yeah, I'm assuming, Tim, I'm assuming you're talking about things like labor, for example, and I'm wondering, what is your biggest inflationary headache, and how do you see that evolving? Is it permanent? Does it revert back?
No, as I said, it's really the biggest impact for us has been the logistics issues, primarily getting merchandise from Asia to the U.S. We ship merchandise all over the world from Asia, and by far the biggest impact has been in the U.S., where established processes for receiving merchandise are just not as forward or as advanced as they are in other parts of the world. So I would expect that over time there will be additional investments in automation in the supply chain, and that will, ultimately end up moderating the impact of the labor cost increases that we've seen.
Tim, can I come back to the demand side of the equation? The U.S. consumer is now facing higher gasoline prices, higher heating bills, higher mortgage costs. It just goes on and on and on.
Yep.
What impact do you think that's going to have on discretionary spend? What impact is that going to have on people wanting to spend money on your gear?
Well, again, it's hard to know, but Americans and consumers in general are going to be buying merchandise. They're not going to stop completely. So our job is going to be to outcompete for consumers' discretionary spend. And we think, being in the outdoor business, the outdoors are available to everyone, and they can be inexpensive. People can go for a hike at a park. They can spend time outside with their kids. They can go play golf at a municipal golf course, or really anywhere. And those are not expensive activities, and people can be safe there. And we've seen a tremendous uptick in the activities that are in the outdoors.
Hey, Tim, before we let you go, can you give us a real-time indicator on what's happening with Omicron? Are you dealing with any staff outages? Are you shutting down anywhere? Are you noticing any change in really short-term spending patterns?
Well, I can tell you our operations in Switzerland have been reduced significantly. They've reduced the amount of people allowed to go into the office. It's mostly work from home. And so those are areas where we've seen impact. really real time.
It's been great to chat. Tim, really appreciate your time and the update. Thank you very much indeed providing us with both. Tim Boyle, Columbia Sportswear Chairman, President, and CEO. This is Bloomberg.